Hello, we are Team 3, and I am Yvonne. Yvonne and my partners are Rosalind and Carrie, and we will be going over the Chapter 8 Accounting for Fiduciary Activities, Custodial, and Trust Funds.
The contents of our presentation covers learning objectives 2, 3, and 5 from chapter 8. They are explaining the purpose, accounting, and financial reporting for commonly used custodial funds, investment trust and private purpose trust funds, and pension trust funds. Starting off with learning objective 1, explain the purpose, accounting, and financial reporting for commonly used custodial funds. What are custodial funds? Custodial funds are financial accounts or savings set up to benefit individuals, organizations, or governments and are administered by individuals, organizations, or governments who have a fiduciary duty to the beneficiary. Fiduciary duty means that an individual, organization, or government has the obligation to act in the best interest of another individual, organization, or government. So, custodial funds are fiduciary funds, and like all fiduciary funds, custodial funds benefit individuals, organizations, and governments that are not part of the reporting entity. This means that the asset of the custodial fund cannot benefit the custodian or the person or entity or government that administers the fund. Not to be confused with trust funds, which are assets that are administered through a trust, assets that are used only to provide benefits to recipients in accordance with benefits terms, assets that are legally protected from the government's creditors. The GASB recognizes custodial funds to not be part of these three types of trust funds. So, in essence, assets that are held in a fiduciary relationship that does not meet the requirements of a trust fund are reported as custodial funds. The figure on the right is a statement of change in assets and liabilities for GovSquam Custodial Fund for the fiscal year 2012. And as you can see, there weren't additions or deductions for that year. Also note that it says agency instead of custodial. This is because prior to 2019, the custodial fund was called the agency fund. After 2019, the GASB Statement 84 renamed agency funds to custodial funds. So, tax custodial funds. Tax custodial funds are created when governments collect taxes for other governments. In the United States, at the local and state government level, it is common for an elected county official to serve as the tax collector, who is responsible for collecting all property taxes owed by persons, businesses, or large corporations that own property in a county. As an example, this illustration shows the tax rate of the custodial funds, Washington Township, and the City of Washington. The tax levied for the Washington Township is $7.10 for every $100 valuation, and the tax levied for the City of Washington is $10.06 for every $100 valuation. The county tax collector collects taxes for these two funds. The Washington Township parcel of land are located outside of the City of Washington and therefore are not under the county's jurisdiction, and that is why they aren't taxed for the city's funds.
Now, finishing off 8.2, recording the Special Assessment Debt Service Custodial Funds would be similar to those illustrated in Chapter 6, except that the government is not obligated in any manner for the special assessment debt. And instead of recording revenues and expenses, we would use accounts similar to the tax custodial funds, such as the additions, principal and interest collections for special assessment bondholders account, and the deductions payments of interest and deductions payments of principal accounts. And lastly, similar to the custodial fund, the special assessment debt service fund would be required to identify and report all additions and deductions to net positions in the statement of changes in fiduciary net position. Now, moving on to the pass-through custodial funds. Now, the grant entitlements are shared revenues from the federal or state governments often pass through one level of government, which is the primary recipient, before distribution to a secondary subrecipient. Now, to determine what kind of involvement it would be needed, it would be the administrative involvement or direct financial involvement, and the requirements for each of these are here on the slides. And once the criteria for the involvement are met, the primary recipient government must recognize a revenue for the receipt of the resources and expenditure expenses for the transfer of resources in a governmental fund, private purpose trust fund, or proprietary funds. Now, the custodial fund financial information is reported in a separate column of the statement of fiduciary net position, and only those assets held for external parties are reported by custodial funds in the statement of fiduciary net position.
So, moving on to learning objective 3, explain the purpose, accounting, and financial reporting for investment trust and private purpose trust funds. So, typically, governments possess idle cash from their long term and short term investments. With effective management of investment, they may place these funds into a pool that is under the control of a treasurer or professional investment manager, and this individual is responsible for making investment decisions on behalf of the fund's investors. This illustration shows or is an example of how assets are transferred into an investment pool to create an investment fund. Private purpose fund. Private
Okay, now moving on to objective 8.5, which is to explain the purpose, accounting, and financial reporting for pension trust funds. Now, pension funds are investment funds created to provide retirement benefits for employees. And there are two types of plans, which are the defined contribution plan and defined benefit plan. And since we are mainly going to look at the defined benefit plan, I'll just quickly go over the contribution plan. Now, the defined contribution plan specifies the amount or rate of contribution that employer and employee must contribute to the members' accounts in the pension plan, and is a very simple plan and very straightforward, where there are less complications towards it. Now, the defined benefit plan provides a specified amount of benefits to a retiree based on a formula that may include factors such as age, salary, and years of employment. And to ensure that plan assets will be adequate to cover future benefits, professional actuaries are engaged to calculate the present value of benefits and required contributions made by employers, and sometimes including employees. Now, since the basic assumption underlying actuary projections may change over time, it requires periodic revisions in the contributions. Now, when reporting the defined benefit pension plan, there are two financial statements, which are the statement of fiduciary net position that shows plan assets, deferred inflows of resources, liabilities, deferred outflows of resources, and net position. And in this statement, plan assets should be reported at fair value. Now, the other statement is the statement of changes in fiduciary net position that shows the additions to plan net position, deduction from plan net position, and net increase in plan net position. And in the statement of changes in fiduciary net position, the employer and employer contributions and investment income is recorded as additions to net position rather than revenues. And similarly, the benefits paid, refunds of contributions, and administrative expenses are reported as deductions from net position rather than expenses. And now looking through the last schedules needed for this pension. Now the schedules of changes in net position, liability, and related ratios. Looking at only certain points of it, we would be looking at the total pension liability, which is the portion of the present value of projected benefit payments to be provided through the pension plan that is attributed to past period of employee service. And within this total pension liability, the service cost is included, which is the portion of the actuarial present value of the projected benefit payments that is attributed to the current year. And then lastly, the covered payroll is the payroll on which contributions to a pension plan are based. Moving on to the schedule of employer contributions, the main information to note in this schedule is the actuarially determined contribution and the portion of that amount that the employer has contributed in each of the last 10 fiscal years. The actuarially determined contribution is a target or recommended contribution to a defined benefit pension plan for the reporting period. Now, based upon external actuarial calculations relative to the most recent asset, measurement, and benefit projections available. And lastly, the schedule of investment returns, and this schedule presents the annual money-weighted rate of return on pension plan investment for each of the last 10 fiscal years. This internal rate of return on pension plan investments is calculated through the net of pension plan investment expense and is adjusted for the changing amounts of actually invested. And then that concludes our presentation, and thank you for watching.